Good day, my name is Philip Chambati, and today I'll be taking you through taxation of individuals. What are our learning outcomes for today? Our first learning outcome is for us to understand employment income and its difference from business income. Secondly, we want to understand the tax computation model of applying payee tables. Thirdly, we want to understand employment benefits. Fourth, we want to understand the treatment of certain types of employment income, such as pension fund transactions, which are covered under Section 81N and Section 81R. We'll also need to understand and be aware of administrative aspects of employment income. And lastly, we're going to have to understand elderly concessions as well as tax credits. So let us get into our lecture. Firstly, what is employment income and how is it different from trade and investment income? To understand this, we'll need to look at the definitions as covered by the legislation. So the first thing is employment income is defined as income earned by an individual in respect of services rendered under any employment contract, and also includes any amounts that are due to the cessation of employment. This can be found under Section 81B. For the definition of trade investment income, we'll need to look at the Section 2, which defines trade investment income as income received or accrued to any person other than a company or trust from any trade and investment and other activities, but does not include income from employment. So for trade and investment, we've been specifically told that it excludes any income that is earned from employment. Therefore, we need to be careful when we're dealing with an individual, as both definitions are talking about persons or individuals. Therefore, this tells us that an individual can earn both employment income and trade and investment income. So when working out the tax payable for an individual, we need to separate employment income from trade and investment income, because these two incomes have been defined differently by the Act, and one of them has specifically excluded the other one. Now let us delve deeper in the definition of employment income. This can be found both, as I said, in Section 81B as well as the 13th schedule. So what does Section 81B talk about? It talks about services that could have been rendered or may yet be rendered by any individual. It also talks about amounts. The amount that will be included in a person's employment income will need to be received or accrued, not necessarily due and payable. 3, it also talks about any amounts that are earned from the cessation of employment should also be included in one's employment income. Now that we've understood what kind of income should be included as per Section 81B, how are these going to be taxed? We'll need to look at your Section 70, 71, and 72 and 73, which cover the administrative issues. And when you read these sections, they then refer you to the 13th schedule, where the 13th schedule specifically covers employees' tax. Now, what does the 13th schedule talk about? The 13th schedule now gives us what an employee is and what an employer is. So what is an employee? An employee, as defined by the 13th schedule, is any individual to whom remuneration is paid or payable at an annual rate. Now we've come up with another word, which is remuneration. What is remuneration? For us to understand what an employee is, we really need to understand what remuneration is, and therefore be able to work out employment income. So the definition of an remuneration is given within the 13th schedule, and this definition covers a lot of areas. It will tell us what is included under remuneration, and also gives us exclusions to remuneration. Now let us go further into these definitions. When you read the definition in the 13th schedule, which I'll leave you to do by yourselves, you find that it includes all manner of income, including salary, leave pay, bonuses, employee benefits as covered under 81F, pension schemes as covered under Section 81R and Section 81N. These are all part of employment income have been included under the definition of remuneration. But what is key now you need to realize is what is excluded. The 13th schedule under the definition of remuneration excludes trade and investment income, also excludes income earned by independent persons or what we call agents, excluding insurance agents. It also excludes director's fees if that director is earning anything other than remuneration. It also includes the amounts earned by board chairmen of statutory entities. Anything that has been exempt under the third schedule is also excluded from the definition of remuneration. It also excludes any amounts that have been paid or are payable to partners through a partnership, and also excludes reimbursement of expenditure incurred by an employee for the purpose of the employer's trade. All of these items are excluded under the definition of remuneration. We need to really look at these exclusions and understand why they've been excluded and where they're excluded. For instance, when we talk about director's fees, a director is not necessarily an employee of the organization unless he's earning something we call remuneration. So in other words, a finance director, for instance, who is considered an employee. Why? Because he earns a salary, he also gets a bonus on top of the board fees he earns for sitting on the board. Whereas a non-executive director only earns board fees and does not earn anything else that may be construed or is under the definition of remuneration. So a non-executive director simply earns board fees, and those board fees will not be taxed as remuneration, but rather will be taxed under trade and investment income for that particular director. The other exclusion that we need to be careful of are the insurance agents and independent issue when it comes to remuneration. So when we're looking at this, let us look at, for instance, an agent. An agent is independent from the person who is giving him his job. In other words, he doesn't necessarily have to do the job at a certain time or in a certain way, which is different from an employee who is not necessarily independent from his employer. An agent or a consultant, for instance, is independent of the client who has given him the job. If you look at TAS, Transaction Advisory Services, they do consultancy work. A client will come in and they will sign a service level agreement with the client and do work for them. However, TAS is independent of the client. In other words, how and when the job they're going to do for the client is done is not up to the client, but up to TAS. Whereas now, if you are employed under Econet, for instance, the time and when and how you do the job is determined and governed by Econet. Next, let us look at the framework for how to calculate employment income. This will be governed under your administrative aspects. So first we need to look at include in employment income anything under section 81B, and also anything that is covered under remuneration, which will include 81F employment benefits and also other benefits that accrue to a person who is under employment. Once we've loaded up all the employment income, we will need to deduct anything that is allowed under section 50. This will give us what our taxable income. Using this taxable income, we will need to calculate, based on our payee tables, a particular amount of tax as per those tables, and from that we'll deduct any credits as covered under section 7 of the Finance Act. After we've deducted our tax credits, we'll add to that our AIDS levy of 3%, and finally come up with an amount that is taxable, and deduct from there any other pay amounts that have been paid earlier in the year to finally come up with our tax liability. Let us look at the administrative aspects as covered under section 71 and 73 and our 13th schedule. Remember, it is section 71 and 73 that determine what is employees tax, of which we are referred by these sections to the 13th schedule to understand how to come up with employees tax. So These sections firstly cover the registration of employers. An employer to be registered is either have to be resident or even non-resident, as long as he employs any member of staff with a gross pay that exceeds $300 a month, or the daily, weekly, or annual equivalent, is required by law to register to ZIMRA in order to be able to withhold pay-as-you-earn tax. Secondly, it also tells us that employers are the ones who are responsible for any under deductions or late payments of pay-as-you-earn. This leads to us understanding to what we call the final deduction system, i.e. the responsibility of paying pay-as-you-earn is not on the employee, but as per section 71 and 73, this responsibility is put on the employer. And all under deductions are the responsibility of the employer and not the employee. And it also leads us to understanding that pay-as-you-earn is a final tax. We also need to understand that any personnel who are employed by more than one employer or are employed for part of a fiscal period will be required to actually fill in a tax return and will not be taxed under the final deduction system because they have been employed by more than one employer or have been employed for part of a fiscal period. We can no longer use the final deduction system for these type of employees. These ones will need to fill in a return and submit it to ZIMRA. So next, let's look at the specific types of employment income that can be earned. So here I'm going to first start with employment benefits under section 81F, which are specifically included under the definition of remuneration in the 13th schedule. So what are employee benefits and how could they possibly be taxed? If you look at section 81F, generally employee benefits are advantages that an employee is given by their employer. And generally, these are taxed according to the cost to the employer. However, there are specific ones that will have a different variation, which will be the value to the employee. We're talking about things like accommodation or furniture use. So let us look at the different types of employee benefits that you might know. First one is the motoring benefit. This is given for the right of use of using a motor vehicle. So we need to distinguish here, we're simply talking about the right of use. And when we're talking about right of use, we're talking about right of use for you to use it for your personal purposes. A delivery boy who uses a vehicle to deliver goods for the company is not given right of use, for he's using that vehicle for the purpose of the company's trade. We need to realize that under employment benefits, motoring benefit will be deemed to be based on the engine capacity and duration of how long this right of use is given to the employee. So it makes reference not necessarily to the cost of the employer, nor to the value of the employee, but have deemed a particular cost to it, as it's difficult to ascertain what the benefit, i.e. to the employee, or the cost to the employer is. So they have deemed a cost based on the engine capacity and the duration of use. We also need to understand under motoring benefit that the motoring benefit specifically scopes out repairs and fuel. Next, let's look at also disposal of a motor vehicle by an employer to the employee. This is another benefit. When you're given right of use of a car, after a certain period of time, that car becomes yours and the company sells it usually below market value. As since you're buying a vehicle below its market value, you are now benefiting. You've been given an advantage from everyone else simply because of the employer-employee relationship you have. You're buying a vehicle at below its market value, and that difference will be an employee benefit and therefore be included in your gross income. Next, you can look at passage benefits. This you need to look at 81F and not 81G. I apologize for the typing error there. It talks about passage benefit. These are benefits that are given to an employee being moved from point A to point B outside of the employment sphere. So when an employee is being moved from Harare to Bulawayo, and the company pays for that movement, that is a passage benefit. Other benefits we can look at are occupation of a resident and the use of furniture. These ones, the reference to the benefit that will be included in your employment income is based on the value to the employee, not necessarily the cost to the employer, as most benefits are. Next, we'll look at the loan benefit. Whenever a company gives you a loan, and you all know that most companies do give loans, they usually give loans at an interest rate that is below the market interest rate, so as to cushion their employees. It is that difference between market value, market interest, and the interest that you've been charged, which is a benefit to you. If you're given a zero interest rate loan, then the benefit will be based with reference to LIBOR. In other words, the 1 plus LIBOR will be your benefit. Next, we look at a complicated one, which are shares acquired pursuant to an employee share option scheme. These are also benefits, but these are specifically included in your act, and you'll need to really read them and understand how these employee share option schemes work and what amount from that share option scheme will be included in my employment income. Now, another special points to note that we're going to look at are your pension. Pensions are particularly difficult, and these will be covered, as we said earlier, under Section 81N and 81R, as well as Section 81A, which covers the annuities. So when we look at the definition of pension fund, this is a fund that is established by any law for the purpose of providing, amongst other things, annuities or pensions, or superannuation or retirement, or a fund registered or provisionally registered as a pension fund or retirement annuity fund under the Pensions and Provident Fund Act. This is a definition under your Section 2. Please understand the definition and see what is included under that definition, because pensions are particularly difficult. Also, you need to get from the definition what a retirement annuity fund is, a RAF, and what is different to a pension fund is. Now, when you look at contributions to a pension fund by employer, these are deductible for the employer, but subject to particular restrictions. So firstly, you look at pension funds other than RAFs, you get a deduction of up to 5,400 per employee. For just a single retirement annuity fund, you get a deduction up to 2,700 per employee. And when you have a mix of both pension funds and retirement annuity funds, you are allowed a deduction of an aggregate amount of a maximum of 5,400 per employee. Next, let's look at pension receipts. These are, again, also you need to look, are covered under Section 81A. Your pension receipts will include things like your pension annuities, which are taxable in equal streams in each year until the person dies. And these are covered under Section 81A and are included under employment income, especially for those who have retired. That pension annuity is not trade investment, but employment income up to a certain amount, obviously excluding any capital that has been invested. Look at Section 81A and the definition of a pension annuity and what amounts are actually included. Next, let's look at our pension lump sums, which are covered under Section 81R. These are fully taxable at the highest marginal rate, but excluding amounts from a RAF. So 81R simply covers pension lump sums, does not cover retirement annuity fund lump sums. These will be covered by another section. Retirement annuity fund annuities are treated the same as pension annuities under Section 81A, whereas the lump sum is covered under Section 81N. And Section 81N talks about the commutation of a retirement annuity lump sum, and what will be taxable is the third of that commutation. Also, your retrenchment package. So for retrenchment package 1, that retrenchment plan needs to be an approved plan. If it's not an approved plan, the exemption does not apply. Please note that. If it is an approved plan, the exemption will be the greater of the person's first 10,000 of the package, or a third of the package up to a maximum of 60,000 of the package. I.e., so in other words, the maximum amount that you can actually exempt from the package is 20,000. So I need you to do some homework. I want you to outline the difference between pension funds, retirement annuity funds, and benefit funds. This will help you understand more clearly how these three types of funds are different and what amounts will be taxable and what amounts will not be taxable in terms of the contributions as well as the receipts. So today, let us look at the concessions to the elderly. So who is elderly as far as our Income Tax Act is concerned? First, it's someone who is over the age of 55. As far as the Act is concerned, someone who's elderly is someone who is 55 years of age at the beginning of the year of assessment. Understand, you are not elderly if you are 55 during the year of assessment. Most concessions talk about someone who's 55 at the beginning of the year of assessment or greater than 55 at the beginning of year of assessment. So we'll look at your rental exemption. Rental income for elderly, the first 3,000 of his rental income is exempt for an elderly person. So too is your back acceptance. The first 3,000 that he earns from back acceptance is exempt from gross income. We also now look at the interest earned on deposits from financial institutions. There's also a credit that is entitled to because you're elderly, which is 900 per year. And also any pension receipts for an elderly person are all exempt from gross income. They also need to look at the motoring disposal benefit. This under section 81F tells us that when a motor vehicle is disposed to an elderly person, no benefit exists for that elderly person. Therefore, there will be nothing included in that elderly person's gross income as far as the disposal is concerned. This is important to note because what the taxman is trying to do with elderly people is to reduce the tax burden for the elderly because they've lived for such a long time and they've already been taxed. We need to reduce the tax burden and be able to let them survive under the small pension amount they actually earn. Now let us look at other specific types of exemptions as covered under section 14 as read with your third schedule. So what is an exemption? So exemptions are different from exclusions. An exclusion is something that does not meet the definition of section 8 of gross income under section 8. That is something that is excluded from gross income. In other words, for instance, a capital receipt. When you receive a capital amount, that amount is excluded from gross income. Whereas an exemption is something that first and foremost meets the definition of section 8. Agreed? But then is specifically exempted under the third schedule. This, for instance, as we've just covered with other exemptions like your rental income. Rental income meets the definition of section 8(1)(a). In other words, it's a revenue amount that you've actually earned and not of a capital nature. However, then when it comes to the exemption, third schedule simply says when you're elderly and you earn such rent income, please do not include it in this person's gross income. We're going to exempt them and we're going to give them a reprieve, a breathing space for that income. So for this, for individuals, we're going to have to look at the section 14, which then refers us to the third schedule, where in the third schedule, all your exemptions are listed. Please go through each of those and understand who they apply to and when they apply. Last but not least, we're going to have to look at your tax credits. These are covered under section 7 of your Charging Act. So what are tax credits? Tax credits specifically are amounts that are credited to a taxpayer after calculating their tax on taxable income, thereby reducing their liability. How are these different from allowable deductions? They're different because these are deducted after coming up with a tax payable. Agreed? So you've already applied your tax tables. Only after you've applied your tax tables do you then deduct credits. What are the key categories when it comes to tax credits? We need to look at your elderly person credit that we've covered. There are also credits for blind people, also for medical expenses, the mentally and physically disabled. All of these are credits that are available to any individual. The next question will be, are credits apportionable? Well, most tax credits are not apportionable. Only your elderly credit, for a given year of assessment, which is less than 12 months, will you be able to apportion an elderly tax credit? Otherwise, most tax credits are not apportionable. They are given in full. Next, you'd ask yourself, if I do get a credit, is it possible for me to transfer that credit to another person? Most credits are not transferable. Are not transferable between people, but you only get your blind people and your mentally disabled or physically disabled person's credit, which is transferable only between spouses. So if I am blind and I am not working, that credit I can give it to my spouse if she is working and has employment income that she's earning. However, if I am earning employment income as a blind person, then that credit should firstly be used for my employee tax and I cannot transfer it. If you have any questions, please feel free to contact any of the lecturing team, which is Reno, Fungai, or me. I hope you enjoyed the lecture and see you next time.